If you look at India's absolutely incredible infrastructure story over the last 3 decades, there's this one unsung hero. It's quietly underwritten almost everything you see. The highways, the power plants, the metros. It wasn't just project finance or equity. It was something way less glamorous, kind of buried deep in all those tender documents, the bank guarantee. For 30 years, BGs have been the language of trust, and honestly, they've done their job brilliantly.
But that brings us to the crucial question we have to ask today. Are the same BG-only structures that built the last 30 years really enough for the next 30? Or is it time for a second engine to help carry the next massive wave of complex, time-sensitive projects? Okay, let's dive into this.
To understand where we're going, we first have to give credit where credit is due. We need to acknowledge why bank guarantees absolutely dominated India's first infrastructure supercycle, and frankly, why they deserve to.
Now, what's really interesting here is just how perfectly BGs fit that era. Think about it. In the 90s and 2000s, projects were pretty linear. Roads, power, irrigation. BGs offered this beautiful simplicity. You had one instrument, one counterparty, a bank. Everybody got it. The whole ecosystem, from contractors to regulators, was built around banks as the primary risk carriers. And for government bodies, a bank guarantee was the absolute gold standard of security. It was the right tool at exactly the right time.
But here's the thing about great tools. The ones that win one era often hit these invisible limits in the next. And that's exactly what's happening with the bank guarantee model today.
And this right here gets to the most crucial point. The real problem isn't the price of a bank guarantee. You might have great pricing, low commission, maybe even zero margin. The real issue is that the total capacity of the entire banking system to issue these guarantees is not infinite. The question quietly changes from how much does it cost to how much is the banking system willing to carry on your name at all?
And this slide shows you why. Banks operate under some really strict rules. They have caps on how much they can lend to a single company or group. They have internal ceilings for specific sectors, like roads or power. And they are constantly managing concentration risk. So even if your project is fantastic, the bank's overall portfolio might just be overexposed. Guarantees consume what's called risk-weighted assets, or RWA, and that puts real pressure on a bank's capital. This, right here, is the invisible wall.
Now, at the very same time, the nature of infrastructure itself is going through this massive transformation. We've moved from just highways and coal plants to massive renewable parks, battery storage, data centers, and green hydrogen projects. These new assets come with way more complex risks, longer-term obligations, and these huge platform-scale bids that require enormous guarantee limits. So the question becomes, should we really expect banks to carry this entire new wave of risk all by themselves?
This is where surety bonds enter the picture. And it's so important to frame this correctly. Surety isn't a replacement for bank guarantees. Think of it as a powerful second engine designed to work right alongside the first, to power the next phase of India's growth. So what exactly is a surety bond? Well, think of it as a way to bring a second global balance sheet into the game. It's an on-demand performance guarantee, just like a BG, but it's issued by an insurance company, and it's backed by a panel of highly rated global reinsurers. For the government body or the project owner, it looks and feels just like the instrument they already know and trust. Okay, so let's break down how this works. This table makes the difference crystal clear. A BG is issued by a bank and often requires you to lock up your cash as collateral. That consumes your bank's valuable RWA. A surety bond, on the other hand, is issued by an insurer. It's typically zero margin, and it's based on a risk premium. The crucial difference, you're tapping into the massive capacity of the global insurance market, not just your bank's balance sheet. You're basically converting trapped collateral into a clean, budgetable expense. And this is where it gets really powerful. This isn't about BG versus surety. It's not a zero-sum game. The BG plus surety model creates a bigger, stronger, more resilient ecosystem where everyone wins. It's truly about growing the entire pie.
For the EPC contractors and developers out there, the benefits are immediate. You get more total guarantee capacity, which means you can bid on and run more projects at the same time. It frees up your traditional bank lines for what they do best, things like working capital and term loans. And with less cash trapped as margin, your capital efficiency just goes through the roof.
Banks win too. They get to reduce their non-fund concentration on a single company or sector, which their risk committees absolutely love. They can prioritize their valuable RWA for funded assets where they actually earn more. And it lowers their headline risk from being overexposed to any one large group. It just lets them be smarter and more strategic.
For insurers and reinsurers, this is an incredible opportunity. It gives them access to a diversified, long-term infrastructure risk that is well underwritten and totally essential to the economy. It's a scalable business that aligns perfectly with their global portfolio logic.
And finally, the ultimate beneficiaries. The government and the public get the biggest win of all. They still get that on-demand protection, but now it's backed by diversified counterparties. This removes a key financial bottleneck, which means infrastructure projects get built faster. It builds systemic resilience. It's a win for everyone. So this brings us right to the core strategic choice, the one that is going to define the winners and losers of the next 3 decades of infrastructure development in India.
The last 30 years were won by a simple, bank-led instrument in a bank-centric world, and BGs did that job exceptionally well, no question. But the future belongs to a more sophisticated twin-engine model.
bank guarantees as the reliable engine 1, and surety as the powerful engine 2, providing that additional thrust we need for the journey ahead. So the real question is simple. Whether you're a contractor, a banker, an insurer, or a government stakeholder, you have to ask yourself, is my strategy designed to keep stretching a single engine beyond its limits? Or am I ready to design a BG plus surety architecture that can safely and efficiently carry the incredible scale of growth that India is aiming for? The choice, really, will determine who wins the next 30 years. If you're ready to explore how this twin-engine model can power your growth, you can reach out to Chaitanya Prabhu V. He's a trade finance specialist. His details are right there on the screen. Thank you for tuning in.